This company didn't fail because it ran out of money. It failed after raising $47 million. At the moment the funding was announced, everything looked right. Press releases went out. Investors celebrated. Employees felt secure. From the outside, the company appeared protected from failure. But here's the uncomfortable reality. Statistically, this is when failure becomes more likely, not less. Funding doesn't eliminate risk. It relocates it. Instead of worrying about survival, companies begin worrying about perception. Instead of asking whether the business works, they ask whether it looks like it works. The danger isn't collapse. The danger is confidence. Because once a company is funded, every mistake takes longer to feel painful. Losses feel theoretical. Time feels abundant. And quietly, without anyone noticing, a countdown begins. Not toward success, but toward the moment when money can no longer hide the truth. Inside funded startups, the atmosphere changes almost immediately. Deadlines feel softer. Urgency relaxes. Decisions that once required proof now require permission. When money is scarce, every action is intentional. When money is abundant, intention fades. Teams stop thinking in weeks and start thinking in quarters. Problems that should feel urgent get postponed. Risks get reframed as experiments. The company hasn't failed, but it has stopped listening. What makes this phase dangerous is that nothing feels wrong. Customers are still signing up. Revenue may still be growing, but speed is replacing understanding. Growth is replacing learning. And the longer this illusion lasts, the harder it becomes to break. Because comfort feels like progress, even when the foundation underneath is quietly weakening. Before funding, startups answer to customers. After funding, they answer to expectations. Founders begin optimizing for investor updates instead of user behavior. Metrics start replacing conversations. Decks replace reality. Monthly reports become more important than customer pain. Growth charts become more important than retention. This shift isn't malicious. It's structural. Once capital enters the picture, survival is no longer the primary pressure. Narrative is. Founders are rewarded for confidence, not caution, for expansion, not restraint. And slowly, the business stops being built for customers and starts being built for the next round. The company still looks healthy, but it's no longer honest. And dishonesty, even subtle, compounds faster than losses ever could. Funding carries an unspoken demand. Scale quickly. New hires, new markets, new features. But scale doesn't fix problems. It amplifies them. Products grow before they're stable. Teams grow before culture exists. Customers arrive before systems are ready. At this stage, mistakes don't break the company immediately. They spread quietly. Support tickets increase. Churn rises slowly. Internal confusion becomes normal. From the outside, growth looks impressive. From the inside, complexity takes over. And once complexity wins, reversing course becomes almost impossible, because slowing down feels like failure, even when it's the only move that could save the company. Burn rate is invisible at first. With millions in the bank, losses feel abstract. Spending feels strategic. Every decision feels justified. Salaries rise. Office space expands. Marketing spend accelerates. Each choice makes sense on its own. Together, they create momentum that can't be stopped. Burn rate doesn't punish optimism immediately. It punishes time. And by the time leadership feels the pressure, the options are gone. Layoffs damage morale. Cutbacks signal weakness. Slowing growth scares investors. So companies keep going, hoping the next milestone will fix everything. It rarely does. Employees inside funded startups believe stability is guaranteed. They relocate, commit fully, build their lives around the company. What they don't see is hesitation. They don't see delayed funding conversations. They don't see runway calculations. Funding creates confidence, even when leadership is quietly concerned. By the time the truth reaches a team, it's already too late to prepare. And when collapse comes, it feels sudden, even though the warning signs were present for months. Almost every post-funding failure traces back to one decision. a senior hire that locked in fixed costs, a market expansion that arrived too early, a burn rate built on future assumptions. At the moment it's made, the decision feels reasonable, even necessary, but months later, it becomes irreversible. Because capital doesn't buy flexibility, it delays consequences, and delayed consequences are always more severe. The most dangerous phase isn't collapse. It's silence. Emails take longer to answer. Introductions slow down. Language becomes cautious. Nothing is officially wrong, but momentum disappears. At this point, survival depends on honesty, and honesty is the hardest thing to offer. Failure doesn't arrive dramatically. It arrives through delays, budget freezes, emergency meetings. From the outside, the company still looks funded. Inside, everyone knows the runway is ending. And when the end finally comes, it feels inevitable, even though it once felt impossible. Here's the truth most founders avoid. In many of these companies, the warning signs were documented in board decks, internal reports, a single number that kept being ignored. The failure wasn't hidden. It was postponed. In Part 2, we'll examine the exact signals that predict post-funding failure, the metrics investors quietly watch, and why almost no one acts on them in time. Because once you understand those signals, funding stops looking like protection. It starts looking like pressure.